The US dollar has dropped to levels we haven't seen in years, hovering around 5 Brazilian reais, and that alone would already be enough to grab attention. But what makes this moment different is not just the price level, it's the context. Institutions like BTG Pactual are already suggesting that the dollar could weaken even further, while at the same time Brazil's stock market is rallying aggressively and foreign capital is flowing into the country at a pace that hasn't been seen in a long time. Billions of dollars are entering Brazil in a relatively short period, and suddenly a market that is usually treated as secondary by global investors is becoming one of the main destinations for capital. So the real question is not just why the dollar is falling, but why Brazil is one of the main beneficiaries of this movement. At a superficial level, the explanation seems simple. Higher interest rates attract capital, stronger capital inflows strengthen the currency, and that pushes the dollar down in local terms. But this explanation is incomplete, because it ignores the global forces that are making Brazil relatively more attractive right now. This is not just about Brazil improving, it is also about the rest of the world becoming more uncertain, more fragmented, and in some cases, less efficient at allocating capital. To understand this properly, you need to zoom out and look at how global capital flows actually work. Money does not move randomly across countries. It follows three main drivers: yield, safety, and growth expectations. For most of the past decade, the United States dominated all three. It offered deep and liquid markets, strong institutional credibility, and the highest concentration of high-growth companies in the world, especially in technology. This created a structural bias where global portfolios became heavily concentrated in U.S. assets, particularly equities. However, when a system becomes too concentrated, even small changes in expectations can trigger large reallocations. That is exactly what we are starting to see. The first layer of this shift comes from policy uncertainty in the United States. Trade tensions, tariff discussions, and political pressure on institutions such as the Federal Reserve have introduced a level of unpredictability that was not present in previous cycles. Figures like Donald Trump have played a role in amplifying this uncertainty, particularly through aggressive trade policies that disrupt global supply chains and create volatility in expectations. Markets can tolerate risk, but they struggle with unpredictability. And when unpredictability increases, capital starts looking for alternatives. The second layer comes from geopolitics. Tensions in the Middle East, particularly involving the United States and Iran, have had a direct impact on global energy markets. The Strait of Hormuz, one of the most critical oil transit routes in the world, has been at the center of these tensions. Any disruption in that region affects oil prices, which in turn affects inflation globally. Higher energy costs feed into transportation, food production, and industrial processes, creating a broad inflationary shock. Normally, this kind of environment would strengthen the dollar, because higher inflation in the US would lead to higher interest rates, attracting capital. But this time, the effect has been partially offset by the uncertainty surrounding the geopolitical situation itself. Investors are not just reacting to inflation, they are reassessing risk. At the same time, there's a structural conversation happening in the background that is often referred to as de-dollarization. This is not a sudden shift, but a gradual process that has been unfolding over the past 2 decades. The share of global reserves held in dollars has declined from above 70% in the early 2000s to closer to the mid-50% range today. Countries are diversifying into gold, alternative currencies, and bilateral trade agreements that bypass the dollar. China has been actively promoting the use of the yuan in international trade, particularly with countries that are part of its economic sphere. In parallel, technological developments are creating new possibilities for settlement systems, including digital assets like Bitcoin. While these alternatives are still far from replacing the dollar, they contribute to a more fragmented system where the dollar's dominance is slightly less absolute. Now, when you combine these global dynamics, policy uncertainty in the US, geopolitical tensions, and gradual diversification away from the dollar, you create an environment where capital starts to look for opportunities outside of the traditional core markets. And this is where Brazil enters the picture. Brazil offers something that is increasingly rare in the current global environment: high real yields combined with scale and liquidity. The country's interest rate differential is one of the highest in the world, making it extremely attractive for carry trade strategies. Investors can borrow in low-yield currencies and allocate capital into Brazilian assets, capturing a significant spread. This is not a new strategy, but it becomes particularly powerful when the yield differential is large and the currency is stable or appreciating. In addition to yield is large, and the currency is stable or appreciating. In addition to yield. Brazil benefits from its role as a major commodity exporter. In a world where supply chains are being disrupted and energy markets are volatile, countries that produce essential resources gain strategic importance. Brazil exports oil, iron ore, soybeans, and a wide range of agricultural products. When global prices for these commodities rise, the country's trade balance improves, bringing more foreign currency into the economy. This creates a reinforcing loop where capital inflows strengthen the currency, which in turn increases investor confidence, attracting even more capital. Another important factor is relative valuation. After years of underperformance compared to U.S. markets, Brazilian equities are relatively cheaper in valuation terms. When global investors start looking for diversification, they are naturally drawn to markets that offer both yield and valuation upside. Brazil fits that profile. The local stock exchange, B3, has seen increased participation from foreign investors, not only in equities but also in fixed income instruments. However, this does not mean that Brazil has become a low-risk environment. Far from it. The country still faces significant challenges, including fiscal uncertainty, political cycles, and structural inefficiencies. Interest rates are expected to decline over time, which could reduce the attractiveness of carry trades. Elections and policy decisions can introduce volatility, and external shocks can quickly reverse capital flows. What we are seeing is not a transformation into a safe haven, but a temporary alignment of factors that make Brazil relatively more attractive compared to other markets. This brings us to the most important point: how to interpret this movement from an investment perspective. The biggest mistake investors make in situations like this is trying to predict short-term currency movements. The dollar is influenced by too many variables: interest rates, geopolitical events, policy decisions, and global risk sentiment. Even professional analysts consistently failed to predict its direction with accuracy. Instead of trying to predict, the focus should be on positioning. A stronger Brazilian real increases purchasing power for international investments, making global assets relatively cheaper. At the same time, local assets continue to offer high yields and exposure to commodities. This creates a unique window where diversification becomes particularly powerful. Rather than choosing between Brazil and international markets, the more effective approach is to combine both. Exposure to Brazil provides yield and commodity-driven upside, while exposure to global assets provides diversification and access to different economic cycles. This reduces dependence on any single outcome and allows the portfolio to adapt to changing conditions. Ultimately, what is happening right now is not just about a weaker dollar or a stronger Brazilian real. It is a reflection of a broader shift in how global capital is being allocated. The world is becoming more fragmented, more complex, and less centered around a single dominant market. In that kind of environment, opportunities are no longer concentrated, they are distributed, and the investors who understand that dynamic are not the ones trying to predict the next move in the dollar. They are the ones positioning themselves to benefit from multiple scenarios at the same time.